Thank you for joining iMeet. When you hear the tone, you will be the 24th person to join the meeting. The meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. We've got a lot to talk about today, so this is probably going to go a little bit longer. If you're new to the webinars, normally we talk about 20-25 minutes, and then we open it up to some questions about individual stocks or sectors, targets, anything that's on your mind about the market. But like today, the subject actually was everybody's making money, but this ain't quite as easy as what it seemed over the last year or two, and it actually turned out to be pretty good timing for that. So what we're going to do today, we're going to look at a lot of different charts, a couple of areas that I think maybe in the process of a breakout to the upside actually, and then we're going to look at the different sectors, see where we might want to get in on some of these on this pullback. Other charts that we just want to keep on our radar as far as places that we may want to jump in, that type of thing. Let's take a look first at the major averages. That's not it. There we are. The major averages, and then we'll go over, talk a little bit about the market itself, what's going on right now, what we want to keep our eyes on, and then we'll look at some different industries in those sectors. Right now, we're still bullish on the Dow. The CTI is a +7. Momentum is a neutral -3. The reason that's neutral is because the Dow Jones continues to outperform almost every other index out there, and that's normally it's not what you ideally what you want. You'd like to see more participation from maybe the small caps and transports and other indexes and stuff like that. Sentiment remains a bearish -3. Investors are still a little bit overly bullish, which is always a little bit of a red flag. It doesn't mean that that you need to sell when that gets to be bearish, but it is at least a little red flag that when everybody's bullish, you have to wonder where the money is. It's going to drive the market higher. But we have some big inflows of money over the last 3 or 4 weeks. 1, 2, 3, 4 of the last 5 weeks, we have had huge amounts of money coming in into equity funds. So whether that's coming in from 401k contributions or foreign markets that are trying to get in on this parabolic move, I don't know, but it is finding its way into the market, and that should help us work our way higher. The breadth is still strong. I had a question, I think it was Susan, wanted me to talk a little bit today about the NYSE AD line, and also talk about the operating companies for that line, and we'll go into that shortly also. Technical indicators are all still bullish, as you can see here. The main thing is we're overbought, and this little bit of a pullback today is and yesterday. At this stage, there's nothing really to worry about. You're so far. Remember, we talked about using our fingers going up from the 100 or the 50-day and seeing how far away you get from this line. The S&P 500 last week was more overbought than it had been in something like 22 years. So the reasons why this market's going up are still intact. Nothing's really changed. But so you can use this opportunity as places that you want to go into and maybe pick up some stocks that you are looking at for the little bit longer term. All right, volatility has spiked here a little bit. We actually got up today to, we're up to about 15. Now, what I look at, hold on here. Okay, when I look at on the volatility, over here we're at 1489. We're up to around 15. This is a chart going back, I think a year and a half, over a year. You can see down here whenever we've gotten down around this 9 level, that was probably a little bit where volatility started to pick up a little bit. And over the last year or so, we've topped out right around 15, 16. We're getting up there right now, so that's something to watch. If we start to pull up, that means that maybe we've approached where this little short-term pull-off is gonna stop, and we might start working our way. So you're gonna see over here comes back pretty quickly. So we'll keep an eye on that. If it does break through this 16 area, 1650, maybe even 17, that would be another red flag for you to watch. And that would mean sometimes when you get something that's going to go towards a 5% correction, something like that, you'll see the VIX spike up to about 20, 21, maybe 23 tops, and then you can pretty much just assume that that's probably going to be it for the for the near term. So again, if all of a sudden we started seeing the VIX spike up, that would be another red flag that we want to watch. The VIX, you can find it every day in the paper, or whatever you're going to look at, or you can go on the market at a glance page on Market Edge, and we have it there for you also. We have Trump's speech tonight, State of the Union, where he's probably going to lay out some more plans for infrastructure spending. That could give a boost tomorrow to some of the material stocks, maybe even to energy. We also have the conclusion of the FOMC meeting tomorrow at 2 o'clock. Just get a little bit more projection on how we're going to be on rates, what they plan to do. I don't think they're going to do much at all. Several reasons. Number one, we have the new Fed chief that's going to be getting the baton, and he's certainly not going to want to come in here and cause a market crash. And just as Janet Yellen isn't going to want to see the market crash as she's heading out the door. So they're going to tend to be a little bit dovish. We could see a little bit more hawkish conversation in that thing. We had the yield of the 10-year Treasuries yesterday hit go above 270. That's the highest they've been in quite a while. I'm not sure exactly when. I don't know if it's a year or 2 years, something like that. But anyway, that is an area that we want to kind of watch. I think that at 3%, you may see more of a sideways motion in the market. As the market right now, it's got to consolidate some of these the rising rates. It's still very low, but then the market can handle little quarter point moves up as rising rates. However, it's the projection, it's the steepness of the hikes that can bother the market. If if all of a sudden 3 months down the road here, you get the FOMC meeting comes out and they say, well, we're going to raise a half, and we may want to do at least 2 or 3 more hikes over the next year. That will bother the market because then the market has it wrong and they're not sure where we're going to go. So we'll talk a little bit about that a little bit later. But anyway, here's the VIX. We're up here around this 15 right now. We get up to about 16 and a half. That may be it for this little thing. That would mean we probably had about a 2.5%, maybe even a 3% pullback. But then I think we should be okay on that. I had a question about this. But here, first of all, this is the NYSE Advanced Decline Line. And this is generally regarded as a leading indicator of what the market is going to do. We see some consolidation a little bit in here. Nothing wrong with that. We're still looks good. We made a new high last week. Now the NYSE AD line is made up of all the stocks that trade on the NYSE. The question came in: can this be deceiving? Because we want to know, are people buying the operating companies? There's another NYSE line that you can dig into. You can find it just has the operating companies, which make about maybe 60% of all the stocks that are traded on the NYSE. Can this fool you? Yeah, but not in here. Susan asked about this. Susan, when this can fool you is in the summertime. Sometimes when we had the rates were getting down here around they were getting around 2.10, things like that, where you had some of the bond funds, some of the preferred stocks. Rates are low. If you got a preferred stock out there paying 8%, it's going up in value. So you had a little bit more advancing issues at that point. But now when you have interest rates going up, this line is going to be even better as an indicator, because those preferred stocks and bond funds and stuff that were making new highs before when rates were going down are not going to be making new highs right now. An indication of that is we saw here yesterday is right here. Okay, we still had, even with that pullback yesterday, we had about 240 issues making new 52-week highs. But all of a sudden you went from like 30 and 40 to you had about 204 new issues making new 52-week lows. Where'd that come from? The market only went down 180 points. Okay, that was your thing where you saw your bond funds and your preferred stocks. Also, as rates go up, I don't want to own those. You know, I'm not happy with that because I'm going to lose my principal on these bond funds and the preferred stocks. So I'm going to dump them. I want to get out of there now, and that's caused the new 52-week lows to go up. So as interest rates go up, they're not really moving today, but again, you're seeing that you only have 37 of the new highs all the way down here, but you have 227 on new lows on the NYSE. Again, that's your bond funds, it's your preferred stocks. Clients are coming in, investors are saying, okay, get me out of there right now. We're going to, rates are going to go up a little bit. I'm going to sell those. So that's causing a spike there. It's like if you see this tomorrow and you saw only 37 new highs with 227 lows, you'd think that if you didn't know about that little piece of tip, you'd think, everything's going down. We're going to have a market crash. That's not the case at all. So that's why people look at the operating company and why it's distorted sometimes, because a lot of those issues that are traded on there are interest rate sensitive. Okay, here's the S&P 500. I told you over here I got some lines that I'll explain. We have those almost parabolic moves since the first of the year. Again, there's some measures this is more overbought than it's been in the last 22 years. If we look at some of the, sometimes when you do a Fibonacci retracements on this, so as I did a couple of them. I did one from here, and then I did another one from back in here. What you want to look for when you put more than one Fibonacci retracement thing up is do I have any lines that are joining together? In this case, we have right around this the 38.2 and the 50% off the shorter term from here joining together here. They also come together right about where the 50-day moving average is, which is right around 2702. Let's say 2705 would be the average. That would be as far as you're going to go, and it was going to on this downside move, and I don't think you'll even hit that. I'm not sure what that would be. It would probably be a 5 or 6% move because I think the market's up about 6 or 7%. So that's one area to watch. I'm more inclined to think we probably go down in here maybe to maybe you get to 2,800. We're at 2825 right now. So maybe you get a little bit stirring the pot a little bit more. You can get down to that 2,800. This area right here. I think that would be fine. But look at the indicators. We're still way overbought. We're starting to work that position off a little bit. You keep your eye on the 14-day RSI. As long as that's above 40, you're generally considered to be in a bull market. We're not even close to that level. The 30-day stochastic, we're still up here in the 90s, maybe 80 by now with today's pullback. But we're still under accumulation. The MACD is showing you that the trend's changing a little bit. No big deal. This is still overbought. So, again, on worst case, maybe we get down around this 2,800. I would think that's probably the downside we're going to get. Here's the NASDAQ with its parabolic move. It has been in a pretty nice little channel, having some little pullbacks occasionally. It has underperformed the Dow Jones the last part of the year here. Then we got this parabolic move again. And here we are again with the overbought indicators, just saying that we could definitely come down here. Old resistance to support, this would be around 7160. Would be about as much as I would look for at that, or 7411 right now. So not even close to that. I would look somewhere maybe around 72 would be about as much as I would think we'd pull back on the NASDAQ in here. Again, just way overbought. That's not a reason to sell, but it is a reason just to be cautious and know that when a market is very overbought like this, the selling can happen a little bit be a little bit more intense because people get a little bit worried because if it's gone up, I think we went 400 days without a 5% pullback, which is the longest in history. So a 3% pullback in here is nothing. So don't get all excited about that. Now, what has some people worried about is there's a lot of investors have come in here that are in the market that are being a little bit more speculative. They've never seen a 5% pullback. So how they will react and how some of these people that are in the passive ETFs doing the passive investing, that's another thing that a lot of people talk about, because if the people are in passive ETF funds and all of a sudden the market begins to pull back and they all of a sudden go, hey, I can lose money in this market, I need to get out of here, that would pick up the selling to the downside, and it would overshoot to the downside and present an opportunity for people, but that can always happen. Here's the NASDAQ advanced decline line. Susan, again, with this, you don't see the hyper move that you had on the NYSE. The listings are a little bit easier on the NASDAQ. Actually, you have premier companies that aren't always going to be moving up. A lot of them don't do anything. But this is still, broke out of this little area here. We're going a little bit sideways in this area. Not too bad. This will probably come down today. We only have it's bad today. I mean, you have about 720 up, 2100 down, about 3 to 1. Nothing crazy though. This isn't foreshadowing a pullback of any kind. Here's your NASDAQ new highs, new lows. Of course, you'd want to see some contraction on a day like yesterday. We're down to 38 today, so it's going to come down here. We have 51. You still only have 51 new lows on the NASDAQ because you don't have all the bond funds and stuff like that in there. So it's a big contraction. You're off 2.5% or something in 2 days. Of course, you're not going to have expansion in that. Not a big deal though. It's just telling you that we're contracting a little bit. Now this would start to spike up here and it crosses places. Then you got a little bit of a little worry. This is back in August. You started to have a little bit of market worry. You started to see that going, but we're not even close to that right now. Here's the Russell 2000. Again, we're following this channel going up. You can see some support and resistance going up the middle of that channel right into here. We kind of broke below the halfway mark there. I would look maybe 1550, 1560 on the Russell. We're at 1585 now. I don't think you'll get past that level right in here. So again, you're overbought. The trend is has turned over a little bit here on the MACD. You've got to come down to the 40, which would be all the way down here before it's considered a bearish pullback. Nothing yet. You're just breaking below the 80 level in there. So just a pullback in an uptrend. Here's the transports. You've had a little struggle over here. A lot of that was last week, but the airlines over the last week or two have struggled. Part of that was United Continental talked about their forward guidance and about some pricing issues that the market didn't like, and that caused all of them to come down about 5%. But again, we're sitting up here about 60 on the RSI, you're about 70 on the 30-day. Really just a pullback. If things would pick up, this little support area back here is also in line with the 50-day. That's 10.7. I don't see that. I don't think we'll get near that. We're at 11.2 right now. Maybe another 300 points. I don't think we'll get to it. All right, here's the SOX, the semiconductor. We're 1358 right in here on this thing. That's not much of a pullback either. Here's the 50-day. A couple weeks ago, at the end of the year, we came down below the 50-day moving average. It traded on there, struggled for a little bit, going sideways. There's a pretty nice pullback in here. We've got some buying opportunities. Now we have an upward trending line over here. Maybe you get down here to 1340 or 1358 right now, down 1.5%. Not a big deal. All your indicators are still bullish. Nothing's telling you that this thing is picking up steam. All right, let's look at a couple things here that I want you to keep an eye on. Okay, light crude. This is oil. Nice little rising channel here over the last since September. We've been basically in there. We were going to come out of our oil stocks around 62. We got a little bit more of a breakout, and now we have a $70 price target on oil. That still stays. That $50 or that $70 target is basically. Remember, we looked a couple weeks ago here. And we looked at the chart going back about 2 or 3 years, and that was a 50% retracement from the highs to the lows. And I think that's probably where we're running the resistance. I would hold on to the oil stocks have not performed with the broader market or with the price of oil that's been going up here lately, and they're getting hit pretty good today. Oil's down 2%. If you don't have any exposure to the oil stocks, this might be an opportunity to maybe kind of take a look around a little bit and see if you can get in here. We're still staying above 62, which was the old resistance. Polarity in the market, that 62 now becomes support. So you want to keep an eye on crude oil. As long as it stays above $62, you want to still own your oil stocks. If it breaks below that 62 and starts heading towards 60, that would be the next support. And if it breaks that 60, we'll know it ahead of time, and hopefully on these talks we'll be talking about that and getting you out of some of these things. But accumulation still looks good. Overbought on the oil a little bit in here, so some sideways action on that also is good.
Yes.
Now, all right. Now here's UUP. This is the U.S. dollar, which I want you to kind of keep an eye on this also. You've heard everybody talking about weakness in the dollar. Mnuchin got this last week. He got a little bit of trouble. Everybody thought he was talking it down. But this is going back 3 years, and you can see this breakout that we've had down here in this descending trend line. This is a little bit of a problem. You can see over here now, here's the 30, so that UUP is trading below the 14-day RSI, which means we're in a bearish condition on the UUP. But you can see the distribution in the dollar. It's not going to bounce higher anytime soon. In fact, I was surprised today. What are we doing today? It's down a little bit, just almost flat, but we're down a little bit today. You're going to get some bounces in here. Maybe from when if they raise the rates, that can cause a bounce in the dollar. If the Fed chief or some of the FOMC committee members talk a little bit more hawkish after the meeting, we'll get an announcement tomorrow afternoon at 2:00. And then it always seems like the next week they all go out and go on the talk circuit, and sometimes you'll hear a little bit different stories coming out of their mouths than what you hear from the official announcement. If they start talking a little bit more hawkish, you could get a little bit of a bounce back up here to this 24 area on the UUP. But I wouldn't be aggressive. I certainly wouldn't be buying the dollar for anything more than a short-term trade. A spike on that would cause the commodities and oil to maybe come down and test that $62 range possibly, because a stronger dollar weighs on the commodities and oil. So part of this is what may be keeping the oil up here around the 65 and may give us the boost if this doesn't come up here and take out this 24.50 area or so like that. They're also actually going to we're going to get a death cross on the UUP here too. That means the 50-day moving average is going to go below the 200. That's not a sign of strength by any means. So we'll keep an eye on this over the next couple of weeks just to see what we can do if we get some volatility and some moves in that. All right, the best performing sectors over the last 1 week, including today, we got two. We got healthcare is up a little bit. We got consumer discretionary. Healthcare, we had a 5% move last week in the biotechs and the IBB, iShares Nasdaq ETF. Good move. We're getting had a little bit of a breakout, and I think we're going to continue to get a breakout in those. You still want to buy some of those on pullbacks. Next week, I plan on talking about some sectors and industries and all that look poised to me that we're going to break out for the next leg up, and we'll look at some of that also. So, what's weak? Pretty much everything else. Energy's gotten hit pretty hard in here. Technology's down. Apple and some of the Apple's causing some problems for that. Industrials is down a little bit. Consumer staples and materials. But again, everything that we looked at was overbought, so nothing to get worried about. All right. The subject today was just a little bit about making money in a bull market. Don't be fooled. It's not that easy. Now, first of all, we're going to just touch on why we're making money in the market, why we keep going up those parabolic moves. We got the tax cuts that come in. We've got deregulation. We're going to have probably an announcement tonight on the infrastructure spending and some goals on that. You have a synchronized global economic recovery. We've got expanding earnings, which should expand. They're looking for earnings to be up at least 10% for the second, third, and up 15% in the fourth quarter. So that can move the market a little bit higher. So you have a lot of money coming in. But these are the reasons why this market has been going up. Okay, what can go wrong? If all that stuff's causing us to go wrong, to go up, what do I need to worry about in here? And you do need to worry about stuff. Markets just don't go straight up. This one has, but believe me, when it turns, it'll turn, and it can turn fast. And hopefully with these talks, I've been in the market for 35 years. I think we can hopefully have some red flags going up, or at least some indications or some negative divergence that'll help us to at least be aware and maybe do some hedging, or at least to come out of some positions. One of the things that worries me and some other analysts is inflation spikes. Again, we talked about that. Things are strong. People are spending money. They're putting money on their credit cards again. If we start getting up here where all of a sudden inflation gets to 2.5%, 3%, it's the Fed's job to put the brakes on if we start to see that. That would mean they would have to raise rates faster than what they're planning on. Okay, low unemployment causes wage inflation, and wage inflation is probably the main factor that the Federal Reserve is going to look at when they consider is inflation really going. Food can go up a little bit, gas can go up, but once the wage inflation starts to kick in, that's hard to control, especially with unemployment rates at almost an all-time low. So they start to go, and there's nobody to hire. Wage inflation causes big problems with this. All right, the market isn't cheap. We're trading right now right around 19.4 times earnings. I think for 2018, if the market stays at that PE level, we could see the market, the S&P 500, go up to about 3,200, I believe, 3,150, something like that. However, if historically over the last, I think, 10 years or so, the S&P 500 is traded at around 16 times earnings. If the market comes back and reverts back to more of the norm, and we get back to where the market's going to trade around 16.5, because they're maybe looking at, maybe towards the end of the year we start to see that, year-over-year comparisons on this year are going to be kind of tough. From last year we were just coming out of, we're just starting to begin this hyper growth and all, and comparisons have been pretty easy. The energy companies are up; some of their earnings are up 100%. But if we go back to about a 16 times earnings, that puts the S&P 500 somewhere around 2,800. Guess what? We're at 2825 right now. So that could cause a problem. All right, global central banks have to coordinate the rate hikes. All of them are in the process right now. Japan, Europe, they're all getting ready to hike rates at the same time. They have to be synchronized together so that they're not uneven. They've got to keep the growth going all over one section of the globe to go faster than the other, and that type of thing. We could have a war. You still have problems with North Korea. The Middle East always has their problems. Volatility in the market. If we start seeing the volatility where we regularly spike up to 18 and back down to 10, back up to 18, back down to 11, this type of thing, our investors going to get worried. Our newbie's going to jump out and just say, this is too nuts for me. I'm up 1,000 one day, down 2,000 the next. Will they start to sell? That could cause the market, money to leave. Higher yields. Again, right now we're thinking the market can certainly handle 3%. We're at 2,715 right now, and that's already causing some concern. Part of that is you can get some institutional players that go, you know what, I can get a 3.5% in here with no risk. I'm going to take 10% of my money out of the market and sit on that for a little bit. Okay, Trump's erratic behavior, like him or hate him, he's a little bit polarizing, and can he blow up? Will he do something where all of a sudden it looks like he's going to get impeached, or maybe, who knows? He could quit. Certainly, the market would not like that uncertainty that crawls in there. And finally, a little trade war with China or NAFTA. I don't think either one will happen, but these are all things that we want to keep our eye on. That if these happen, you're going to have to change your allocation to the market, reduce your risk, and hopefully we'll be talking about some of these things as we go forward here, because these are things that we want to keep on our radar and not just be, walking down the yellow brick road hoping we're going to, the market never goes down. It will, and hopefully we'll work on this stuff and navigate through the thing. All right, real quickly here, I knew this was going to be a little bit longer, but I'm going to try to go as fast as I can with this last part. Okay, let's look at a couple sectors where we may want to jump in. This is the healthcare sector. You can see this thing, again, another parabolic move. A lot of this was that 5% move in the biotechs. Pharmaceuticals are also had a great week last week. I think they were up about 3%. They had Pfizer came out with their earnings today, and it traded down. Probably a little bit of a head of itself. You can see the overbought condition in the healthcare sector. And we want to, take that. You can come back down into this channel. It'd be nice. But the healthcare, especially the biotech, I think is a position that you still want to be at. Everything still looks good in this. Accumulation's actually picked up, just way overbought. That's a good area, a good one to pull back in here. Here's the IBB iShares. As you can see over here, this was that big breakout that we talked about last year all the time. We finally got it. Came down. Again, this is called polarity. When old resistance becomes support, that's polarity in the market, and you can see with that breakout price, which was 300. They did the reverse split on this thing. Came down, tested that breakout price twice in here. It's bounced off, and now we've broken out again. It could pull back maybe to this 114 area. Would probably be a good area to buy. You can see we're still overbought. Lots of room. We can come down here, maybe get down to 112 area. Still, I would be buying the biotechs, and you want to buy a little bit of a basket. That's the same thing we just looked at. Okay. Here's technology. Again, we had a nice little channel going up. Broke out of that channel. If we pull all the way back to the 38.2% on the Fibonacci retracement, you'd come back to this area here where we had some back and forth trading. I don't think you're going to get that. I don't even think you'll get back down to the 50-day moving average on this thing. All the indicators were overbought. They're still all bullish. Nice accumulation. Nothing really to worry about on that. Look for your stocks that you want to buy in that. Industrials, again, another parabolic move. Look at that thing. Okay, we're pulling back, but look at this. We talk about this a lot on the accumulation AD line. This isn't you and I buying that. This is institutions going into the industrials. Part of this, the falling dollar. Falling dollar, the companies like McDonald's, they have a lot of multinational sales revenues. Falling dollar takes away the currency risk, so that your earnings actually will look better overseas when you have a weak dollar. That's helping these companies, to move up. Your Boeing, your Lockheed Martin, these type of things, your defense areas. Well, we're going to go over exactly which industries are expanding in these real quick too. But again, this is the one you want to be into, especially the multinationals. Here's the financials. Again, a parabolic move. Look at this accumulation on that. This is the money centers, the brokerage, security dealers. This is the money centers, the regional banks. Insurance companies have struggled a little bit, but they still look good. Diversified financial services, some of the mortgage companies are still looking good. Overbought, can do a little bit of a pullback. We're out of the channel. We can maybe even pull back to that, but I don't think you'll even get that on this thing. Here's energy, another parabolic move. Again, accumulation. The oil stocks have not kept up with this for some reason, and I'm not exactly sure why. I think maybe just you have a couple individual stocks that have done well. But I think some of these we're getting stretched. Your Exxon Mobil is getting stretched. Chevron seems to be a little bit stretched. They've had a pretty good move up in here. I still think you can work your way higher, but we're still in a bullish trend on that. Maybe you get down from 75 down to 73. Unless you get down to 62, you're not going to see this come down to the 50-day moving average. We're 64.5. Things, some of these sectors and stocks are actually, starting to maybe have bounced off some levels in here. So energy may be good to buy on the pullback. Here's materials. Again, if this group could get a bounce. Hey, Will, could you start looking at those questions? You can make it a bounce tonight from the infrastructure on Trump's speech. What looks good in here, the building materials, some of the steel, the aluminums, stocks like that, some of the mining stocks. We bought XME in the sector and industry portfolio a couple weeks ago. That still looks good. Here's, okay, I'm going to wrap this up and just go over one or two more things real quick. We're going to look at this again next week when we talk about breakouts. This is a 3-year chart on gold, and let me find my notes in here. This is something I want to keep my eye on here, because what we're seeing on this could be a pretty big breakout out of an ascending triangle pattern that if we break through here to go about 1380, it could mean a couple different things. You're seeing accumulation down here. You're seeing it bullish in here. Everything's up here. You want to see this 14-day RSI. If it can get up over 70 and get a little bit more overbought, that would mean it would have even more positive momentum. And what this is going to tell you, this may be what the I guess maybe you could call it the nervous Nelly chart, where this is telling you that maybe people, there's a group out there that they're actually saying, hey, look, we can't, we're not going to get, the inflation is picking up. What do you do when you have inflation? You buy gold stocks. And I've lost part of my notes in here. I'm sorry, but you buy something. You look at gold to buy that, and sorry about this. And once you buy when you buy the gold as a hedge for inflation, they may be looking at this, and there may be a group that think that guess what? We're going to have more of a inflation build up than I think we're going to have. That's going to cause a problem in this area, and I want to own gold as an inflation. Maybe the war thing is also bothering them. But if this thing breaks out, it's something that's coming out of a 3-year pattern, and it will be bullish for gold. We're going to see if it's going to struggle here. It didn't break out here, came back, and it came up here again now. We pulled back. It's flat today. But this is going to be something we're going to keep our eye on, because this thing has a big breakout. That could be a leading indicator to us that are watching. I don't hear anybody talking about buying gold on TV right now. But if we see this we want to know about it, and we want to start looking at the gold mining stocks and some of the gold companies and that kind of thing. Okay, I had a couple questions come in, and we'll start getting to these right now. So if you have some questions, go ahead and come in. Oh, before I get to these, one of the things you want to look at in Market Edge in our industry group analysis, when you have a pullback like this, and some of you may be sitting on some stocks that you bought. You're watching the market going up every day, 200 points a day. You got a stock that you're sitting on there, and it does nothing. You're saying, God, I'm in the financials, and this stock isn't doing anything. All right, what you can do if you go into in the industries section of Market Edge, and go to sort them by relative strength, and you're going to find what industries in the sectors are outperforming. Like with the healthcare, the Amazon, J.P. Morgan, Berkshire Hathaway little thing here may cloud the rise a little bit. But what's been working in the healthcare has been healthcare products, medical supplies, biotech, pharmaceuticals. You go in there, click on that industry, you're going to get a list of the strongest stocks in that area. So if you have a medical stock that hasn't done anything in the last 2 months, while everything else is going up, it's time to get out of that thing and then buy on this pullback. One of the ones that have been going up. The stocks that have led going into this into a pullback will be the same stocks that will lead it going out, unless of course you have a sell-off where also everybody's going to the utilities or something like that. Okay, XLY, the retailers have had a heck of a run going in here. The apparel retailers, the drug-based retailers, retail internet, of course that's mostly Amazon, but some of these Chinese internet retailers. Footwear has been strong. Food retailers, casinos, except for Wynn. Casinos may be offering you a chance, specialty retailers, the Home Depot, the Ulta, that type of thing. Restaurants, lodging, those have been outperforming. If you have some stocks that that haven't been moving with the rest of the group, get out of them, go into some of these stocks that have been outperforming. If you've got a nice pullback and you can move that funds into something that's working. XLK, technology. What's working on that? Any of the internet sections, financials, retail, content, services, diversified technology, telecommunications equipment, electrical equipment, the industrials, we talked a little bit about that, factory equipment, conglomerates, defense, heavy machinery, industrial services. Related to that, some of the transports. You can look at some of the trucking and air freight and couriers. Those still look good. Some of the rails have been doing good. The rails and airlines, though, have had a little bit of struggle. They may be pulling back to enough now that you can look at it to see if they're going to bottom yet. But I think we said the transports could go down as low as 10,770 or 10,990. So if you have another day on that, you may want to look at the airlines and stuff at that point. Okay, you look at the financials, security brokers, internet financials. They do great. Money center banks, regional banks, diversified financial services. XLE and the energy. What's been outperforming? The oil field equipment, the oil secondary, the refiners and stuff, the drilling, the integrated majors. The materials, you look at stuff like aluminum, steel, diversified mining metals, non-ferrous metals, building materials, that type of thing. There's a lot of overlap in some of these areas, so you can, find some of the stuff. Something like a BLDR, builder's source or something like that. Not only is it going to be good for infrastructure, it sells to construction guys, it's selling materials. It's also a specialty retailer. Those are ones you want to look at. Okay, the question's coming in right now because this was Sienna. What do I think about Sienna? Not much. It's one of the groups here. You had a little bit of a bounce in this thing here, but it came back. You got the 14-day RSI is down here flirting with this 40 level. It looks to go below that. It breaks below this this trend line over here, and that'll break the pivot point. You could go down and get at least get a retest for that. I think the question was, is it a bottoming pattern? Yeah, kind of, but I don't like the fact that no one's really buying it. You know, it's going sideways, which is good. Which ideally, what you want to see is you have something like this, and you're watching this line down here starting to move up. That means that while the stock's doing nothing, you're getting a lot of underlying buying into it. That's what you want to. That's probably going to cause it to break to the upside. This may be hinting to us that this could break out to the downside. So I would wait to buy a Sienna. I wouldn't be a buyer of that right in here. The other one was Caterpillar. You see all this thing going sideways during this part here. This was where they weren't sure what was going to be happening with earnings, whether they're going to still have the growth in the emerging markets. With the dollar falling, that was certainly that's bullish for emerging markets, and that Caterpillar does like 60-70% of their sales in foreign markets, so that caused this thing to parabolic move up, have a little bit of a pullback, no big deal. The accumulation's there, so you want to buy Caterpillar on any kind of pullback. Ideally, if this thing's pick up, you can get down to the 50-day, be all over it, but I don't think you'll get down that far. I'd probably look at this area over here where it went sideways at the first of the year. Okay, I want to try to get to these. I've got a lot of questions. Again, I apologize for going over, but we're trying to do this for you guys, and I hope that we can, do something. Okay, win versus LVS. I don't have to look at it. Go with LVS. IBB versus XBI. Not much difference in that. The IBB is a NASDAQ. XBI is S&P. Both of them are going to break out. We can look at those next week. As far as which one we may want to look at, which looks stronger, but I think the IBB probably has some smaller ones in there which you want to look at. Okay, would you hold on to Apple? If I've been a long term, I think Apple's going lower over the short term. There will be a point on that where they'll come in. I think I'm not sure what their earnings are going to. They seem to always pull something out of the hat. But a lot of people are really nervous about their projections for the iPhone, and that's still their main deal. I can try to look at Apple here a little bit. Depot is listed as a strong buy, but today has reached its sell stop. Your thoughts? Depot is a little small biotech. It's traded down here. Let me see here. Okay, it's down here. One thing, I had a question about sell stops, which I want to bring to your attention. The sell stops in Market Edge are based around two different things. Number one, it takes a former area of support. As the stock moves up, that sell stop will move up. And it also takes into consideration the volatility of the stock. In other words, if the stock is a high volatile stock and it moves 10% a day, we're not going to put a sell stop in there that's right at support. You're going to have to give it some leeway on 10% or either way of the support level, so you don't get stopped out. Number two, especially on the when you put in a sell stop, you want to do it mentally. The reason being, if you just put in a sell stop, so I want to get out of Depot at 5. When you have a day like today, market makers are going to go ahead and make that the market. You go, okay, we have a sell down here at 5. Okay, we'll go down here. That's the market. We'll see if we have anybody who's going to buy it down there. I'll buy it because I think the market, the market makers can buy your stock down there. You make the market then at that level. They'll come down and take you out, especially on a like I say, on a day like this. It's not fair, but that's what they do. That's why you want to kind of have a mental stop. And another way to look at that is some traders will a little bit swing traders will look for a stock to close below that sell stop. Maybe even close a second day below that sell stop before they move on it, especially if they don't want to get out of it. But again, if you just put in sell stop orders across the board, you'll get taken out of everything today at down $5, and at the end of the day, everything's only down $3. So you want to be careful on that, and don't want to learn that the hard way. Did I hear that right? Look at the strongest sectors and see if any of my positions are underperforming and move the funds of positions outperforming. Yeah, that's what I do. It's called momentum investing. And like I say, if I have something that hasn't moved over the last, if I'm watching all the, let's say apparel retailers, American Eagle Outfitters, Urban, Abercrombie & Fitch, whatever, they're all up 25, 30%, Kohl's, that kind of thing, and I'm in Joe's plaid shirts or something, Madras shorts, and I'm down a quarter, I'm out. You see a sector that's moving, don't sit around and wait. There's a reason. Technical analysis. We may not know the reason why that thing's underperforming, but there is a reason, and no one's buying it. Now, fundamentalists may sit there and go, "There's nothing wrong with that stock. I don't know why it's not moving. I'm going to load up on it. It's underperforming, and then when it starts to join with the sector, rising tide lifts all ships. Then I'll make my money." And by the time it starts to move up, the other stocks may have already all come down, and that move in that sector's over. So when you have a market like this, there's no sense sitting on dead money. So I think we're still, like we looked at that sector map a while back. I still think we probably have another year and a half of a good market. So that's why sit on something again? Oil stocks may go up 30%. Your oil stock goes up 5%. By the time yours does start to move, everything else comes down. You miss the whole move, and you've been sitting on a loser stock. So momentum investing, you want to be with the winners, and that's so if you have something, go into the industries on market edge and go from there. Hey, listen, I'm getting hoarse on this. I've talked too much. If you have any other questions, go ahead and email dblake@marketedge.com or wait for pull that. So for Kohl's, I guess you're talking about. Yeah, I mean anything you get a pullback in here you want to look at, and a 2-day move like this, you don't want to be a hero and jump in there and hey, I'm jumping in right now. I had a pullback. You have, like I say, you have the speech tonight. You got the FOMC meeting tomorrow. You got a couple of things that are going on. You had 400 days with a 5% pullback. So I mean, don't be surprised. But again, the things of what can bring an end to this bull market. I don't see any of those things happening yet. I do see what's causing the market to go up. All those are still in place. This is just nothing but a little hiccup. And when I was a broker a long time ago, we used to call these the hand-holding days, where our clients paid us to tell them, hey, everything's going to be all right. Of course, then it would go down 20%, we'd lose our client. But no. But again, this is just something here that it's a natural thing in the market. We haven't seen it in a long time. Don't get freaked out about it. Next week when we get here, if we look at some of these things or you go back here and look at this and say, okay, well these are things I need to be worried about. None of that's happening. That means the market it's just a pullback, and the market should work its way up. Okay, I'm going to go ahead and wrap it up. Listen, I appreciate you taking your time out of your busy day to join me with this. I hope I gave you a little bit of knowledge that you can work with, and hope again the idea here is for us to hold on to what we got and try to make some money. Have a good week.